Okay, let's go ahead and get started. My name is Kathy Lien, and I'm the managing partner of BKForex Advisors, as well as the director of currency research for GFT, and I want to welcome all of you in today's session. There's a lot that we're going to be talking about, so I'm glad that all of you are happening in the U.S. elections and how this could potentially impact the major currencies. Then we're going to go on and we're going to talk about some of the big topics of the week, such as oil prices. I'll show you some charts and how oil shocks can impact the U.S. dollar. As you may know, since the beginning of the year, we've had oil prices rise more than 10%. So, that's naturally going to have a bit of a impact on global growth. So we'll take a look at that. We'll talk about that. I'll answer your questions, as we go along. But actually, it's probably best to save the questions to the end, because right now I'm just talking about the vocals dance. It's best if you save your questions at the end, because I'm going to be looking at screens, and so I won't see your questions until the very end. After we talk about oil, we're going to talk about the ECB's LTRO program, how it could impact stocks, how it could impact currencies. I'll show you an interesting chart on dollar yen and why this strong rally we've seen in dollar yen could continue, and why today's dip could be just a corrective move. And then finally, we're going to end up with a little momentum strategy to take advantage of short-term movements in the euro dollar. So a lot to talk about today. The topic, on the agenda was mostly French and U.S. elections, but we're going to cover a lot more than that. So with that, I'm going to show you on my screen. So just give me 1 second. Okay. So I think right now you should see a picture of a very, very handsome gentleman. And I want you to look at this picture because this will be the man that could potentially wreak a little havoc for the euro dollar this year. Now, you may know that 2012 is a very big year for politics, with 10 countries holding presidential elections. There's going to be a potential leadership change here in the U.S., where I live, as well as a leadership change in France. Aside from that, we've got elections in Russia, Venezuela, Hong Kong, Finland, India, South Korea, Mexico, and Taiwan. So a lot of countries with a lot of very important events, but some of them will have more of an impact on financial markets than others. For example, the outcome of the elections in Hong Kong, Finland, Taiwan will only impact the markets domestically, whereas the outcome of the U.S. and the French elections could have global repercussions. Now, in France, campaigning is already underway. On February 13th, Sarkozy announced his official presidential bid, and the economy will be at the top of the agenda. Now, his biggest contender is this man that you're looking at here, and this man's name is François Hollande. And Mr. François Hollande is a very, very strong contender for the election. And this is very important because the elections are coming, especially the one in France, is coming at a very critical juncture in the Eurozone economy. There's a lot of intense discussions about the additional support of Germany and France to Greece, and whether or not the European Union is going to increase their financial firepower. Germany and France have led these discussions and basically single-handedly crafted Eurozone policy. Yes, the other Eurozone members, their votes are important, but not as important as the leadership that we're getting from France and Germany. Now, Germany has France pretty much in its back pocket. So if we do get a little leadership change and this man that you're looking at takes power, we could potentially have a situation where there's more blocks than progress in terms of Eurozone support. Now, just a little bit about the elections and Hollande. I mean, right now, the reason why the debate is so tight and why Sarkozy is not a shoo-in for re-election is because France is desperately in need of some change. As you may know, the French economy, as like many other economies in the region, are not doing very well. The unemployment rate is at 9.9%, and the current account in 2005, which swung to deficit, has steadily deepened since then. You may also know that earlier this year, Standard & Poor's stripped France of its AAA credit rating. It didn't deal a huge blow to the French or the economy or the Eurozone, but credibility-wise, it's a pretty big deal. So the economy is at the top of many of French voters' minds as they prepare for a two-round presidential election. So when it comes to France, there's two dates that to focus on. One is April 27th, which is the first round of the election, and the second is May 6th. So there's two potential volatility-inducing events in terms of the French election. And the two frontrunners are going to be Sarkozy and his socialist rival, Mr. François Hollande. And in terms of both candidates, they have a pledge to reduce the budget deficit, though Mr. Hollande has given himself a year more than Mr. Sarkozy to eliminate the deficit. And as we walk into this kind of election, the bad news is that both candidates look as if they mean to tame deficit using mostly tax increases versus spending cuts. So this would obviously be very bad for the French economy because it means more austerity. On Mr. Sarkozy's watch, the public sector in France, the deficit has ballooned to 57% of GDP. So raising taxes further would signal unwillingness to grapple with the inefficiencies of the French state. And it really is a struggle for France because what they really need at this point is measures to induce growth. And based upon experience, tax rises lead to more pullback in growth than any sort of acceleration. So that is why the market's desperate for change. Or not the market, voters are desperate for change. And, whether it's a good thing or a bad thing, Mr. Hollande is actually leading in the polls right now. So what he wants to do is he wants to raise taxes on the wealthy in order to pay for new teaching jobs. He wants to raise spending, and he wants to reverse Mr. Sarkozy's pension reform, which would put the retirement age back at 60 versus 62. So these are very popular measures, and you can tell, since these are such popular measures, that there's a very good chance that he could actually win elections. Now, if he wins elections, it's probably going to be more bearish than bullish for the euro-dollar initially, and the reason for that is, the markets hate political uncertainty. So if Mr. Hollande wins elections, there's going to be a lot of uncertainty as to whether or not, French and German relations are going to sour, and whether he's going to oppose more support for the Eurozone more aggressively than Sarkozy. So I think that, there's a lot, people aren't paying enough attention to what's going on in France, and they're not paying enough attention to the risk that a Sarkozy loss could pose for the eurodollar, for the Eurozone sovereign debt crisis in general, and for the financial markets. So I think that, it's a little bit early with just right now, in the end of February. We still have 2 months to go before the first French election. But as we get deeper into March and as we get deeper into April, it's going to be a much bigger topic of conversation, and it will probably be a much greater pressure on the eurodollar than anything else. Now, next up is going to be the U.S. elections. And in terms of the U.S. elections, I want to call your attention to this chart here. In terms of the presidential battle, let me just make sure you've got my chart shown. In terms of presidential battle in the U.S., right now we're focused on the Republican contender and who's going to be, basically running against President Obama. And right now, there's still a heated debate on who's going to be the leading contender. And everyone has their own opinion, but I think it won't be till August when we have the Republican National Convention that we will actually know who will be the Republican contender. And that's really going to be when the presidential battle in Washington really heats up. And so once again, the economy is going to be at the top of the agenda in the U.S. elections, and we still have a whole bunch of months between now till then. So the only thing that I really want to call your attention to is this chart here. Now, I took a look at the elections that we've had in the U.S. over the past 5 decades, and that's basically covered 17 election years. And I found that in the past 5 decades, we had stocks fall 4 out of 17 election years. Now, using the Deutschmark as a proxy for the euro, we analyzed the data on the eurodollar going back to the 1970s, which covers 9 election years in the U.S. And as shown in the graph that you're looking at here, what I found was that the eurodollar actually weakened 8 out of the 9 election years by an average of 6%. So the green bars are the eurodollar, and the blue bars is S&P 500. And so, seasonality doesn't always, okay, so the chart's not showing. Let me just refresh the chart. So right now you should see the chart. Seasonality doesn't hold 100% of the time. But when we have such a strong scenario like we have here, where 8 out of the last 9 election years, which basically covers 40 years worth of elections, we've had the eurodollar weaken in the election year. So the eurodollar is performing quite strongly since the beginning of 2012. I mean, basically we started 2012 at 129.50, and right now we're trading, almost 500 pips higher at 134. But given how the eurodollar has performed during past election years, it tells us that it may not do so well this election year either. So that suggests to us that we could see some of these gains in the eurodollar start to evaporate as the year progresses. And this would not be out of line with fundamentals, because if we do have the pullback in growth that many people expect due to the belt-tightening measures by governments around the world, then we could have a deeper slowdown in growth, which could lead to easier monetary policy by the Europeans, which could hence hurt the eurodollar. So in terms of just what's going on fundamentally in the eurodollar this year, a pullback would not be out of the question. And from a seasonality perspective, we know that election years tend to be much more positive for the dollar against the euro than negative. Now, interestingly enough, there's no consistent election year patterns in dollar yen or the dollar index. But there is a very consistent pattern in the eurodollar that is worth watching. Another thing, so that's basically what I want to show you in terms of elections and how that, talk a little bit about how that could impact currencies. The next thing that I want to show you is something that is pretty, give me one second, let me refresh my page. Something that is pretty current right now. Okay, right now you should be looking at a little table that I have here, or a little chart that says 1973 oil shock. Now, one of the biggest topics of conversation right now is the fact that oil prices are rising very strongly. Since the beginning of the year, crude prices are up 11%. So, I mean, that's a pretty big deal because it's a very, kind of sharp rise over a very short period of time. And I mean, this is the highest level that we've seen crude prices pretty much since the early second quarter of 2011. Now, oil price shocks are pretty damaging to the global economy. And one of the reasons why we've seen such a deep pullback in currencies today, or specifically certain currencies more than others, is because people are worried about what this decline in oil prices means for the global economy. Now, the Federal Reserve conducted a study a couple of years ago that said that for every sustained $10 rise in oil prices, GDP tends to be cut between 0.2 to 0.3%, because basically GDP is shaped by 0.2 to 0.3%. So we have had a more than $10 rise in oil prices over the past 2 months. In fact, we have oil prices rising. I guess it rose from 98 all the way to a high of about $111 a barrel. One of the saving graces this time around is that it's been a warmer winter here in the U.S. So as a result, heating bills are not as high, but we could see, if the oil prices rise is sustained, we could see a negative impact in the U.S. dollar. I mean, if you took a look at how the dollar index has been moving, we have had a little bit of a decline in the U.S. dollar since mid-January. The dollar index back on January 13th was trading as high as 81.50, and now it's at about 78.50. So this chart here shows you the performance of oil against the dollar index. And you can see whenever we have a big shock rise in oil prices, like we did in 1973, which is the red line here, we tend to see the beginnings of a steeper slide in the U.S. dollar. We saw a similar move in 1979 when we had, persistent rises in oil prices. That tends to be a precursor to a move lower in the U.S. dollar. And that shouldn't surprise you at all, because when we have a rise in oil prices, it tends to hurt growth, which tends to be, negative for, what's happening in the U.S. Just refresh my chart. And so I think that, this is something that people are not paying enough attention to either. We're only beginning to hear a little bit about the concerns about oil because everyone's been focused on Europe. But I think that as time progresses, the rise in oil could match the European sovereign debt crisis in terms of the risks that it poses to the global economy. So I would watch this closely, and this is why people are talking about it so much, is because for every $10 rise in oil, it does hurt or cut GDP growth by 0.2 to 0.3%. So keep an eye on that, because that's a pretty big deal in the market. Another big event risk this week is the European Central Bank's long-term refinancing operation. Now, this is the second time that the ECB is conducting this operation. Their first LTRO had a very significant impact on the market. And you can even argue that their first long-term refinancing operation single-handedly sparked this, beautiful rally that we've had in stocks and in equities around the world. Now, what you're looking at right now is a little chart that I put together using Bloomberg. And the vertical line going down this chart basically shows the day that the ECB conducted the first LTRO operation. And the yellow line is the S&P 500, the orange line is the German DAX stock market, and the white line is the euro dollar. And you can see that from the LTRO operation in December to now, we have the S&P 500 up 11% and the German DAX up as much as 20%. And at the time, if you remember, the LTRO was about 480 billion euros, which, at the time is a very large amount. So, this week on Wednesday, we've got the second LTRO program by the ECB. Now, the question is, will we have as strong of an impact on the markets, or will the LTRO program have as strong of an impact on the markets as the first LTRO program? Well, first of all, if the market's looking for the February LTRO program to be about the same amount as the December program, which means that they're expecting about 500 billion euros. If we have a LTRO at about 500 billion euros, the impact on the markets should be more limited. We will probably not see another 20% rise in the DAX or another 11% rise in the S&P. These indices have risen significantly over a very short period of time. If they were to rise further, it was considered very, very overbought. But if we do get an LTRO uptake of anything close to €1 trillion, which is a number that has been floated around in the market, we could see a very, very strong move in stocks. But unfortunately, it would also hurt the euro dollar quite a bit. Because if you look at this chart here, the white line's the euro dollar. And when we had the ECB LTRO program, initially we had quite a steep sell-off in the euro dollar. I mean, basically it went from 131 down to 126 pretty much. And the reason for that is because the ECB essentially flooded the markets with a tremendous amount of liquidity. And by flooding the markets with a tremendous amount of liquidity, they're basically, making each euro worth less. And that's, caused quite a bit of weakness in the euro dollar. So at €1 trillion, that would be quite damaging. Or €1 trillion liquidity injection, that would be quite damaging for the euro dollar. But if that were to occur, that we would probably get the same type of reaction than we had back in December or earlier this year, which is that we would initially have a very sharp sell-off, but because the LTRO provided so much cheap money into the market, that would actually encourage, a continuation of this risk rally, and that would ease credit conditions, which would kind of, keep some of these credit spreads in Europe intact. And that would actually turn out to be more positive than negative for the euro dollar, because when we have stability in the financial markets, people become a little less concerned about what's happening in terms of growth. And so, and also, how much of a blow the European sovereign debt crisis could be. And so that could, kind of help the euro dollar extend its gain. I mean, basically the way you have to think about it is that if we have banks, taking a lot of this LTRO and operations, and they're willing to recycle this money, as the ECB hopes, in sovereign debt by buying, bonds of Portugal and Ireland and Italy and Spain and things like that. That means that the engine is working and their efforts are, working. And so that would help to ease a lot of the concerns in the credit crisis. So this week's LTR program is a very big deal. If we get less than 500 billion euros, if we get like 250 billion euros or something along those lines, that would actually be negative for stocks and positive for the euro, because it would mean that we would have less money flooding into the market. There would be a little bit of a silver lining there, because it would also mean that banks don't feel like they need to borrow more, because they may feel like they have enough money. But I think that initially it'd be more a knee-jerk reaction, probably negative stocks. But it'll be positive for the euro, because it means that less money is flooding into the markets, and banks perhaps need less help. So if we're trading the ECB LTRO operation this Wednesday, that's what you need to focus on. 500 billion is in line. 250 billion should be euro positive. 1 trillion should be euro negative. But the knee-jerk reaction probably won't last, because it's really the impact on risk that will determine how the euro dollar trades. Okay, so the next thing that I want to show you, and I apologize for jumping around, but these are all part of our topic of conversation, is this crazy move in dollar yen. Now, I put together these two charts for dollar yen that I want to show you. Last week, we had I'm not a really big fan of, or I don't really use Ichimoku clouds, but this pattern that we're seeing is too strong to ignore. And there's a very good reason why, even though we've already had a very strong move in dollar yen, that we could be witnessing the end of a long downtrend in the currency pair and the beginning of what could be a much stronger uptrend in dollar yen. So right now, the first chart you're looking at is a weekly chart of dollar yen. And this is the first time in a very long time that we have seen dollar yen close above the Ichimoku cloud. And usually when this happens, it tends to be a huge precursor to a very strong move upwards. Since 1995, we have had 5 breaks including this one, of the upward Ichimoku cloud. And the second chart shows you that. So this is the second chart of the Ichimoku cloud. I have put an arrow at each point that we have had the currency pair go from well below the cloud for a long period of time above the cloud. And what you'll see is that in 1995, hopefully you can see my mouse moving around, when dollar yen closed above the cloud, it rose, the rally in the pair went from 97 all the way up to its record high of 146. In 2000, when it closed above the cloud, dollar yen rallied from 108.50 all the way up to 134. In 2005, when we had a close above the cloud, it went from 108.50 all the way up to 124. In 2009, we did have a false break in the cloud. It closed above the cloud and then its downtrend reverted. But, we are coming from very low levels here in dollar yen. I don't think we'll be seeing the pair back at 60 because this is what the previous false break alluded to, which is pretty much a 20, maybe like a 15 yen sell-off in dollar yen. But if this close holds, then we could see dollar yen trading rally up to a minimum of 90 and possibly even a stronger move beyond that. Now today you will see that we have a pullback in dollar yen and quite a steep one if you're just looking at the chart. But for the most part, as long as dollar yen holds above 79.70, and let me just show you my dollar yen chart for a second. Let me just pull up my dollar yen chart on my trading station, and then I'll share with you my screen. Okay. So right now we're looking at a dollar yen chart, and what you'll see here is that this 79.70 level, which is right around here, well, actually I would say 79.90, is 79.70, 79.90 is pretty much the former breakout, one of the former breakout points in dollar yen. And if I had added my double Bollinger Bands, which is something that we use for our trading, you'll see that it is also, just give me 1 second to set up my double Bollinger Band. You'll see that it is also the first standard deviation Bollinger Band, which indicates that, it's a pretty important support level for dollar yen. So as long as the currency pair holds above that level, then the uptrend remains intact. And so that tells us that we could still have that move higher up towards 90 in dollar yen. So let me just refresh my chart for you. Okay, so right now you should see the dollar yen chart with a double Bollinger Band. The 79.90 level, which is where the first standard deviation Bollinger Band is a very important support level for the pair. So as long as it holds above this price point, then the uptrend's intact, and this is just a corrective move within a broader rally, and then we could have, a stronger move up to 90. Now, of course, if dollar yen breaks below this, then it would have been a failed false break, and then we could have a steeper slide back towards 78 and maybe even 77. But for the most part, this is a very, very significant break higher in dollar yen, the weekly cloud close, and it's so significant that even I, who hardly use Ichimoku cloud, cannot ignore this move that is happening. So with that, the other thing that I wanted to share with you is a little bit about what we do at in terms of shorter term trading strategies. Now let me just flip over to the Eurodollar chart. This year at BK, we have introduced something that is called our BK flow trade. And this is a short-term trading strategy that takes advantage of momentum moves in the euro dollar. It's based upon the premise of targeting round numbers. And it's based upon the idea that round numbers are very significant to the markets, to traders, and whenever we get a nice little momentum move in a currency pair, there's a good chance it likes to aim for the round numbers. So what I'm going to do is I'm going to set up my euro dollar chart. Just give me 1 second to do that, and I'll give you a gist of what this idea, this strategy is all about. So let me describe to you where this idea came from. I want you all to imagine, let me refresh my camera. I want you all to imagine that we're on a football field, and the goals on both sides are the round numbers. So let's say the left-hand goal post is maybe 133.00, and the right-hand goal post is maybe 134.00, and the halfway mark is 50. So the half of the whole, field is basically 50. So if you imagine that we, have the ball, and we're going from the right-hand side to the left-hand side. So let's say our player has the ball, they're going from right-hand side to left-hand side. They're going from the figure on the other side, they've got the ball, they're running, and they get to the 50 point. Once they get past the 50 point from the other side, they go to 50, 40, 30 towards 133, there's a very good chance that, since it has so much momentum, to get from 134, the goal and all the other side, and they pass the 50 mark, then there's a very good chance that they're going to make it to the goal post on the other side, which is the 133.00. And this is what we're trying to basically capitalize on. That's an example of, a move from 134 down to 133. On the flip side, let's imagine that we're in the left side goal post. So we're at 133, and we're running with the ball, and we're getting to 133.50. Once we get past 133.50, we get to 133.60, 70, 80, there's a good chance that we can hit the goal on the other side at 134. So this is the kind of thing that we're trying to basically trade, which is that people, as human beings, think in round numbers. So that's also where a lot of orders sit. And so a lot of people will try to target the round numbers. Now, we've done a lot of refinement work. We don't go for the full 00, but that's kind of the basic premise of what we do with our flow trades, which is that we're trading momentum, and we're basically trying to target the round numbers. So I'm going to minimize my hot time screen, so I won't be able to see your questions, but I will be showing you my chart. Okay, so I want to show you basically some of the flow trades that we did last week. So the most recent flow trade that we did last week was actually what we had on Friday. Let me scroll over to Friday. Okay, so let me refresh my screen so you can see properly. Alright, can you see my screen? Alright. So right now you should see my screen. So this is an example. It doesn't matter what chart you use. It's just a 5-minute chart allows us to have good illustration purposes. So this is an example of a trade where we're coming from 133, and you see that the currency pair is basically trading at 133, and this trade you'll have to nurse for a little while. I'm going to show you 133.50. The way this trade works is that we're going long at 133.50. And you can see that this move gets as high as, well, it gets much higher. It gets, it becomes a really strong move that keeps on going. But you can see that we've got 133, And the currency pair has enough momentum to go from 133 up to 133.50. And so you lay your limit order to go long there. And it takes some time, but it eventually hits the other round number on the other side, 134. And this strategy, I mean, there's a lot of derivations of it that we do at BK, but it's just based on the whole premise that if we have enough momentum, there's a couple of rules that we have here. We only trade the strategy between 4 a.m. to 12 p.m. Eastern time, and we're only looking for setups during that time. It's okay if we have the strategy trigger during that time, but we don't necessarily close it during that time. But we'll lay on trades between 4 to 12, and then we'll put on trades at 133.50, and we'll nurse the trade until it gets to, we don't go all the way to 134, but we do go, close that level, because sometimes there's a lot of orders at 134. So what we'll do is we'll, take off our position, slightly before that. And we've got some videos on this, on exactly how we do this at BKForex Advisors, and let me send you the link if you just give me 1 second, where we actually describe this in much more finite detail. We show examples and everything like that. So I encourage you to watch this video here. The other type of trades that we take at BK are what we call the Bollinger Band turn trades. Now, I'm going to show you a trade that we took, the only trade that we took last week. Let me just set up my Bollinger Band. Give me 1 second. And the whole idea behind the Bollinger Band turn trade is that instead of trying to arbitrarily pick a top or bottom, what we like to do instead is we like to wait for the currency pair to turn outside of the Bollinger Band. And last week was a really nice example of that we had in pound dollar. And pound dollar's been, obeying the Bollinger Bands really, really well. Give me 1 second to set up my pound dollar chart. Okay, so I'm just adding the first standard deviation Bollinger Band here. Alright, awesome. Okay, so let me just share with you my screen. Alright, so the way the Bollinger Bands work here is that if you're looking at this with me for the very first time, the outside lines are the second standard deviation Bollinger Band, so they're default. The inside lines are the first standard deviation Bollinger Band. And so what we do is that typically when the currency pair's trend is very strong, it likes to remain in the 1-2 band. So in this uptrend in the pound dollar, the trend was strong, it remains in the 1-2 band upside. When the downtrend was very strong, like in this case, the currency pair remains, within the downtrend. But if you're looking to pick tops or bottoms, when it comes out of the uptrend or downtrend, what I want you to notice is that frequently it will touch the Bollinger Band on the other side. So let's just kind of work backwards from here, where get some more data on our chart. Alright, so here we go. So basically we have the pound dollar. So let's say we're trading this uptrend here. It came outside the Bollinger Band. What you'll notice is it frequently touches the first standard deviation Bollinger Band the other side. In this case, it turned outside of it. It didn't quite do it, but the next time it turned outside of it, it did end up touching the Bollinger Band the other side. This one turned outside of it. It took a little while, but touched the Bollinger Band the other side. This one turned out of it, got just within tips of the Bollinger Band the other side, so we'll consider it's good enough. This one, it turned out of it, touched the Bollinger Band the other side. This one, it went into the uptrend zone a little bit, then touched the Bollinger Band the other side, and it did it again and again. And then in the most recent price action, we were in an uptrend. When it came out of it, it touched the Bollinger Band the other side. And so last week, we were in the downtrend. then we saw the pound dollar rally close back above the first standard deviation Bollinger Band. So we took this trade and targeting the Bollinger Band on the other side. So that's another type of what we call swing trade that we look for when we have different types of trading opportunities at BK. So that's basically what I want to share with you in terms of describing what we do. At BKForex Advisors, we provide a tremendous amount of different types of trades. Some of them are more short term, some of them are more, slightly longer term. And long term in FX is, far shorter than in equities. So we do 1 to 2 flow trades a day, 1 to 2 swing trades a week. Then we do about 8 to 12 calendar calls a week, which basically give you our biases of economic data. So I encourage you all to take a look at our website, take a look at that. At bare minimum, at the very top of our site, we have a free newsletter for you to sign up for, where you can get updates on what we're doing and maybe some occasional trading lessons and trading strategies. So I encourage you to sign up for a free newsletter. And with that, I want to open up the floor for any quick questions you have about anything we talked about today. The French elections, the oil prices, ECB LTRO, the dollar yen, weekly cloud, or what we do at BKForex Advisors. The calendar calls are basically we give you our biases of how economic data is going to come out, whether we think that the pending home sales report will be strong or weak, and whether we think that Australian employment numbers are going to be strong or weak, and how to trade them. Can you comment on whether it will touch euro dollar? Can you comment on whether it will touch 127? Well, let me actually show you a chart real quick that shows you how we would think. Let me just pull up the euro dollar chart. Although I think that fundamentally there's a lot of reasons why the rally in the euro dollar could lose momentum. Because I'm a trader first and a analyst second, and we base a lot of our trading on these Bollinger Bands, I would not go short the euro dollar until it closes below the first standard deviation Bollinger Band. And 127 is a pretty steep slide from here. And in order for that to happen, we would need to go into the 1-2 Bollinger Band, the downside. We would need to go from the uptrend into the range trading zone, into the Bollinger Band downside, break below 130. And if we break below 130, that's when we have a chance of hitting 127. But as long as it holds above 130, I don't think that's necessarily going to happen. As the way things stand right now, the uptrend in the euro dollar is still intact. Do you have some bad trades that you can show us? Well, certainly. I mean, for example, if we're taking a look at the same chart here on the Bollinger Band turn trades, you can see, sorry, I have this one screen that keeps on popping up. You can see here that in this case here, we have the euro dollar closing below the first standard deviation Bollinger Band, and then it doesn't continue. It doesn't touch the Bollinger Band on the other side. But with this strategy, our stops would be pretty much a little bit above the first standard deviation Bollinger Band. So your risk reward is much better in this trade. Whereas when you do get a turn, a nice turn like this one, the one that you have here, the risk reward offsets the losses. Hi Kathy, do you use GFT for your trading? If so, any particular reason? Yes, I do use GFT for my trading, but I encourage you to do your own due diligence in terms of finding brokers. Do you see us in a long-term uptrend for now? I see us in a uptrend for the euro dollar for now. Timing is always difficult, but I do think, like I said, as long as we do not close below the first standard deviation Bollinger Band, I'll be a buyer in dips looking for a further move higher. Do you think that Greece's problems will be fixed, or is it not fixable? I think that Greece's problems will go away in a sense, that we do basically have the right tools in place for Greece to receive its second bailout program. I think they will receive the money. I don't necessarily think that they're going to avoid default, But the fear is not so much about Greece because they represent a very small part of Eurozone GDP. The fear is much more about whether there's contagion. And I think that, contagion is not such a big risk if the sovereign debt spreads remain steady. And I think that with the new ECB LTRO program, that could be the case. While the cloud shows a break dollar yen, do you regard yen's fundamentals to have weakened? Hence, fundamentals supporting technicals to upside. In a sense, yes, but more so because of the dollar than the yen. What we have going on right now is that we have U.S. yield spreads, or U.S. yield, period, rising. The market, believe it or not, is beginning to price in an earlier rate hike from the Federal Reserve than what the Federal Reserve signaled. The Federal Reserve signaled that they can raise interest rates in 2014. Market's pricing in the possibility that happening in 2013. And that's because we've had a nice little improvement in U.S. data. So if those improvements continue, then the dollar-yen rally is supported. Of course, on the other side of the equation, we do have the Bank of Japan increasing monetary stimulus, and that's also weakening the yen. Wouldn't the euro-yen be more suitable for flow trades considering the volatility? It could be, Josh, and I encourage you to look at it yourself. But we like to focus primarily on the majors. And so we're doing this in euro dollar, and we're going to expand it very soon to another currency pair, but it'll also be a major currency pair. Japan, yes, Japan has serious debt problems. The U.S. also has serious debt problems. And I think that if you trade dollar yen, you realize that's much more about the U.S. than it is about Japan. And it's much more about how people feel about U.S. dollars and where U.S. yields are going. By that reasoning, shouldn't euro dollar head down considering long-term interest rate differential set to narrow even further? Well, in terms of dollar yen, it's always more about U.S. yields and what's going on in the U.S. than what it is happening in Japan. The euro dollar, on the other hand, what is happening in Europe and the developments in the sovereign debt crisis is important to the euro dollar and does matter, as well as growth in Eurozone and things like that. So it's basically the whole idea that, Japanese data has zero impact on dollar yen, whereas Eurozone data does have an impact in euros. It's not just about interest rate differentials when it comes to the euro dollar. But very good question. Any other questions? Do I see the euro dollar touching new lows in 2012 like 125? I don't necessarily see that happening. I mean, I could see maybe a little bit of a slide if the whole Greek second bailout gets derailed. But just a couple of minutes ago, we had the German parliament approving the bailout in Greece, so that's another hurdle overcome. So we're moving in the right direction. Is the Bollinger Band chart a daily chart? Yes, it is a daily chart. A euro-yen trade may be good. I mean, we're not necessarily looking at euro-yen right now, but if I pulled up a chart of euro-yen, you'll see that we've got a really nice parabolic move in euro-yen right now. Do you see euro-Aussie going further down with the recent retracement? Well, let's pull up a euro-Aussie chart real quick. And I'll just take one more question beyond that, and then have to say goodbye. Okay, so we do have a really deep pullback in Euro-Aussie, and it is worrying me because it's such a strong candle. But in this case, we need to close below 124 for us to assault the new, for us to have a chance of hitting the lows at 121. Let me refresh my screen. But at this point, this does harken back to the price action we saw during this period here, which is worrying me. But as soon as we close below the first standard deviation of Bollinger Band, I'm going to be looking for much stronger losses. And then finally, would CAD be propelled from good LTRO, considering that it's a main trading partner for the U.S.? Well, if we look at how the CAD performed after the last LTRO, it's a big LTRO that, yes, it benefited significantly from the December LTR program and should benefit as well as we get anything close to 1 trillion euros But of course, it's always the size of the LTRO that's going to play a role. So anyway, I've got to go. Encourage you all to take a look at our website, BKForexAdvisors.com. And if you don't follow me already on Twitter, I'm tweeting throughout the day at Kathy Lien FX. So please log on there and join our conversation. And you can always ask me questions there as well. Thank you so much. I hope you enjoyed this fundamentals and funny mental conversation.